do this. Sorry, guys. 1 second. I'm trying to get to my channel here. Okay. Boom. I think I'm on, but I think my microphone is doing well today. I don't know. So let's see if this would work. Okay. I know I should have like tinkered with it a bit more. Hello, Manuel. Thank you for joining. All right. So I have not been on quite a few days. Hi, Michael. Thank you for joining. Appreciate you. Did you hear me well or not really well? How's my microphone doing? I feel like I need a new microphone. Hold on, actually. Increase the thing real quick. I think I'm good. We will see. We will see. Okay. All right. So it seems like a slow week this week. Sounds good. Okay. Thank you. I can hear you. Fine. Great. Nice. All right. Thank you so much, you guys, for jumping in. I know I don't have anything planned today. It's just like, random thoughts here and there. Of course, I've been watching this guy about, option volatility, try to learn as much as I can about that one. He seems very knowledgeable, of course, like he just came in the scene talking about GameStop's kind of like very uh, current, right? So I don't know if he had any previous
The
video.
reasons to trade off.
Recent video or past video about GameStop. So it seems like the popularity of GameStop has increased in this past few months. Ever since Roaring Kitty come back, of course, it puts GME on the map again. Now, of course, it's worth noted that this popularity is going to pump people's up excitement, disappointment. All of it is gonna combine in that as well. So just be aware if you're trading it, coming into the company just recently, thinking you're gonna make $1 billion in one call option. You're not gonna do that, right? And you're most likely to lose out on that one. So it's worth notice. I know, like if you've been watching me, I have my own strategy going on here. It's worth developing a strategy that works for you so that you're not losing out on the opportunity as well as the, you know, the what is it called? The opportunity to invest in the long term and also the short term, price appreciation, right? Again, I don't know what's going to happen, you know? And so that's why I developed the strategy that I have to at least take advantage of the short term and as well as long term. Of course, I'm leaning towards the long term. Of course, I'm always gonna accumulate as much as I can, and my price point right now is like anything under 50. I'm gonna do the same amount of buying rates, whatever my set price is. Again, currently $200 a month, but of course it could be going up as my expenses and all that stuff, right? So that is my long term bag, right? Of course, I dub it as my moon bag, and that's only MOAS, right? That MOAS, of course, people think it's gonna happen right away. I don't know. I'm more leaning towards like it's going to be a multi-year type things, right? When all of these come to fruition, that's when MOAS is happening. So I don't know. I'm not trying to deter you from, making a gazillions of dollars on call option or put option or whatever. If you want to do it, if you could do it, do you, right? You do you, I'll do me type thing, right? And for me, look, if you want to sell and make profit and all that stuff, it really doesn't do much for this stock, right? Because if volume comes and people sell, it's not going to do much to the stock because in my opinion, people own the float already, right? Again, it's just my opinion. I can't verify that, but based on the amount that I've accumulated over the 3 years, right? I have more shares more than 3 years ago. And so 3 years ago, if you were to do the math, how many in the float, how many is still out there, how many people have been accumulating, I don't see why not we're owning the float already, right? Just my personal opinion. And so, and on top of that, now GME as a company becomes stronger in the financial standpoint, based on the financial standpoint. So of course, it's going to it's going to bring more people in to try to get into this company because now it's profitable, right? You could say that with certainty. You don't need to speculate anymore. I don't need to speculate anymore. Like 6 months ago, of course, it was a speculation, right? Because we're still in the minus in the trailing 12. And, if you watch me throughout, even before when Kitty come back the second time, um, people were 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 saying, "Oh, why are you like investing in this company and it's not, doing much right at the moment." So remember when we were here, right here, negative $8 million. People like, this company isn't making me money. So yeah, at that point, I was speculating that are going to come to the positive side. There you go. So now we're here. We've been here for two quarters already, right? And of course, there's a lot of naysayers out there who still have everything negative to say about this company. And I get it. Look, it's a highly controversial company, to say the least. And this is where I see the opportunity, right? When we were here losing $100 million for the trailing 12, people were already making the assumption that this company is going under, right? Without looking at anything else but the top line revenue. That's when they miss out on this particular company. If I had sold back when it was $10, I would have missed out tremendously, right? Not only that, I would lose my original position, I would have missed out on the run right here. And even right now, let's say you didn't sell, which I didn't, right? Some of it is my sister. Yes, I have to sell because that's what she wanted. She need the money, but it's just my sister portion. Um, and so, but my portion is still intact, right? I have not sold anything up and down here. But um, hold on, let me see. So if you were to um, even when you buy over here before the earnings report right here, right? You're still in the green, like right here. So at $16, you're still up about, hold on, at a current state, 50%, right? That's a pretty good gain right there. And my thought is that, this company has been going through a lot, and has the history that you should be at least put the company on the map, right? So that you at least watch it's happening in front of your eyes. But again, it's blossoming very slowly. I get it. This is a very slow churning company, but I think again, leadership is intentionally doing it this way so that we have a longer, multi-year growth, layer growth of, better investor, right? People who are here for the long term and not here just for a quick buck. And I really think that this is why Ryan Cohen did the dilutions and all that stuff. Um, Again, not only to create capital, right? To create massive amount of war chest, so to speak. Now we have $4 billion. I mean, come on, nobody could beat that. So any retail company would kill to have this amount of cash building into it, and on top of that, the you know the availability of this amount of cash will quickly turn into something better, right? Now I listen to like Warren Buffett a lot, and I think when people were asking Warren Buffett why you have so much cash, on hand. Like if it's like in the history of war of um, uh, Berkshire Hathaway, you've never had this amount of cash. And then he said, "Well, I don't think anyone knows what to do with $1 billion." So that's his response. It just means that there's no opportunity out there currently, right? Because everything is, like I said, overinflated and overpriced. If you buy into any company right now that are making profit and all that stuff, you are buying into the premium, and you're paying 10 times, 100 times, 60 times its earnings, right? And so even though it's a stable company, right, doing all the correct thing, making all of the net income, they are still well, if you were to buy any company that is profitable, you're paying premium for that. And so that's not the smart investment, right? Um, Even though, if it's a profitable company. Now, my speculation is that they should uh, not getting into the public traded company, so to speak. They should go into privately owned company, right? That is not publicly traded, so that the they're less likely to be attacked in terms of price, right? In my opinion, right? They could still attack it elsewhere, but the opportunity is in the privately owned sector, and who has the availability or have the network to know which company in the private sector to get into better than Brian Cohen. I'm sure he has a network of millionaire billionaires, or people who are actually trying to build something tangible, so again, having this cash is it's immensely already. Sorry, I'm deviating from my own topic here. Good day, B. Thank you. Can't stop. Stop. Yeah. Thank you for joining. Gonna save those billions and then pounds later. Yeah. uh, I hate to use that term. What is it called? Pounds. Oh, not Ryan Cohen. Adam Aaron used the term choke on that or something like that, right? Like, one of those terms is just like makes me feel like the comparison between AMC and GME. Again, this is psychological. I think this is why the media use that the two to kind of compare to GME. Anyway, I hope that makes sense. Sorry, you guys, I'm kind of flustering today. I don't know why. But anyway, so let's take a look at. I know, like I've gone through a lot in the balance sheets standpoint. I understand like people might be watching me the first time, so they might not understand how I operate. Um, but I was looking at this real quick right here. Hold on, let me see if I can string it. Might be too small for you guys to see. My comparison is through this recent quarter. You see this gross profit versus the gross profit of right here. So it's flat in a sense, but look at the top line revenue. It's $1 billion difference, you guys. So it means that we have a better profit margin. You see, like back then, it's only 21% profit margin. And just go to show that top line revenue is not everything, right? Because there's no reason to be losing $500 million in order to have a top line revenue $1 billion more than it is today, right? Um, it again, you're not making any money by having $1 billion more of top line revenue, you know. And in this environment too, it's like it just go to show you that there's not enough demand to have top line revenue $5 billion at the current state of economy. So um, therefore, this is why we're profitable now, because we're operating better, right? Better profit margin. Seems like, well, this is a trailing 12. So we are up 4%, 4 percentage point, close to 4.5% actually. So, I mean, any analysts out there who are honest with themselves would tell you this, right? Would give you a honest assessment on this company. Um, Now, another thing that's worth looking at, look, positive EBITDA. I know EBITDA is not as good as EBIT. We want this to be positive, but at least this is an incremental improvement that we need to take a look at. It means that the health of the company, as far as like the business side, I'm not talking about the cash position here, but the business side is doing better, right? At the very least, we're close to clean slate as much as possible here. And so, we are losing less right here. Um, you know, just a year ago, we were in the hundreds of millions of dollars. Okay. Right now, we're tens of millions of dollars. So that's like tenfold. Okay. The 10, I guess, uh, my point is that we're losing less money. So, and it takes a while to burn through $4 billion. Come on. Like, when I say a while, I mean like a lifetime. At this burning rate? Come on. Serious. Are you serious? And I heard Michael Pachter, right, saying, at this rate, they're going to still be bankrupt in 4 to 5 years or whatever. It's like, really? Are you really serious? Serious analysis on this particular company? Come on. I mean, the only way that GME would go bankrupt in 4 or 5 years as if they're burning $1 billion a year. Do you hear how stupid that is? You think that Brian Cohen's gonna burn $1 billion a year? And even then, just 4 years of marketable security, right? I know I bring that up a lot, but $200 million a year times 4, that's $1 billion. Again, like that would take them 5 years of burning through $1 billion in order to be bankrupt in 5 years. And even then, we still have like assets. So it's not even like 5 years is not even possible unless they lose $2 billion a year. Then okay, that might be possible. But man, like this is why I hate like listening to people who are like intentionally um intentionally trying to steer you the wrong way, and they do that on purpose. In my opinion, obviously you could have your own opinion. I'm sure some people would believe these people, right, to the T. This person right here probably is worth believing, sure. But man, like if you don't do your own assessment, you're gonna be led to a different conclusion that might have you like feeling confused or something about this company. And again, to me, we're still in the minority. I feel like, people who are actually looking into the balance sheets of the company and all that stuff. Yes, we are gaining more and more traction in the people that are actually looking in this company as a fundamental play now. But when we were losing a lot of cash right here, nobody believed in the company at all. And again, to me, that's an opportunity, right? But currently, we have more people coming in, so it's a good thing. But it's still, though, you could still feel like people are still on the fence. People are hearing all of those negativity from the news. Still, and so this is precisely why they miss out on good companies out there. Right? Just found your channel, great content. Keep up with. Oh, thank you, appreciate you, both. Appreciate you. But anyway, so again, to me, this is worth taking a look at, right? For those of you who are new to the GME bandwagon, right, quote unquote. I hate to say bandwagon because it's not really anymore. It's becoming legitimized in terms of the company balance sheets here. And people are going to find out, slowly. 5 years from now, people are going to be like, oh, shit, I thought GME is gonna go bankrupt in 5 years. They're still here. What? They make what? How much? $1 billion? It's like, told you. But yeah, again, it, it's a no-brainer in my opinion. Even at this price point right here, it's a no-brainer. Now let's take a look at the chart real quick. Now I'm not a chart person, TA person. I'm not, claiming to know anything about that. Um, I briefly was a day trader before and try to do but fail miserably. Right? I mean, I don't lose the money that I've gained years before. It's just that I lost some of my gain from the year before. So technically, I didn't lose anything. It's just that time, right? But I look at it as a learning experience. So, hey, I know something a little bit about like technical analysis and all that stuff, but not enough to be a pro or anything like that. But anyway, so I was looking at this and it was like, oh, head and shoulder, right? Look at this. Boom, right? Okay. Similarity, pattern, but it doesn't mean that it's going to play out that way. So, what happened over here? If you take a look at this right here, this is when, oh, I could draw a cat right here. Shout out to Roy and Kitty. But so in this particular one is a uh the first dilution, right? When we made uh or offer up the shares and made close to $1 billion on that one. After that happens, the price point went up. Okay. So I'm assuming the same thing. Of course, this is just an assumption, but instead of making um, $1 billion, this time we were able to do $2 billion, 2.2 billion actually. Let's do two. Sorry. There you go. So $2 billion. So what do you think is going to happen? I'm sure it's going to consolidate for a little bit of time. Might be another week or two, because it seems like it's being stretched here. The amount of time it takes from the drop to here. So they might drawn out another 2 weeks or so. So this is 14 days. That's 2 weeks. So from here to here. So we might be due for another spike. Again, in my opinion, if it plays out that way. It could spike down as well, you guys. Come on. So just be careful on this one. Please don't take any trade based on this. I'm just an amateur here. My other price target is like down here, 17. It could happen that way as well. Just be aware of that. Now, if it ever comes down to 17, you guys, it's a no-brainer. At every price point, even 20, no-brainer. Why? Why no-brainer? Because down here was 50% or close to 50% equity. Okay, 50% equity. Okay, right now, if it's down here, it's another 50% equity. So, meaning that you're buying the company at a 50% discount. Okay, so courtesy to Moran's right there, right? That's what he. Sorry. So again, it's if it's $20, that means that you have the ability to, as if you're buying it at $10 a share. The same ability for you to own that company or GME at 50% equity. To me, that's a pretty good deal, right? Because we don't have the ability to buy it before the run at all because we weren't here over here. Now, over here, DFV was buying it at uh, 200% equity, right? So, and then Ryan Cohen got in at 150 or 120% equity. Again, I'm ballparking, based on their uh, early entry. And so Ryan Cohen got in around here, right? Um, that's based on the filing and all that stuff. You could go back and read the letter to the board when Brian Cohen got in. Uh, so that's gonna tell you what timeline he got in. And of course, ever since then, we know that this particular run right here was DFE doubled down, right? So technically, he bought over here as well. Um, what is it? 9. So at this particular junction, the equity was a little bit skewed, but again, just a ballpark here. Um, and then at this junction right here, 50% equity. Right? So it changed because the company is doing better. It changed because the cash raise, the dilutions, and all that stuff. So understand that, and then you would be kind of like staying a little bit zen over here. You don't like bog down by the price action and say, "Oh, I gotta get in now," or you're gonna miss out. No, just stay patient. The price is gonna come to you. What is typical percentage and why is it important? Typical percentage. Well, it depends, right? Because I use shareholder equity. The typical percentage, of course, like the best percentage is 100%. It's rare that you would be able to get into the company at 200%. Right? And so this is why it's almost like for every dollar that you spend, the company is going to pay you $2 in cash. So that's why it's 200%, right? Of course, this is a ballpark. I don't know what Roaring Kitty uh, price base at that time was, right? And so I'm just speculating because based on his live stream, he was live streaming right here. Um, this is before he became famous, right? Nobody knows anything about Roaring Kitty right here. And he, is like famously, I'm sure he was adding over here as well. He been in the company pretty long, right? And been tracking it and all that stuff, right? And so again, when he got in around here, and even Brian Cohen got in over here, that was an opportunity of a lifetime right there, right? But again, that's not come that doesn't come without challenge, right? Because you need to make the company being seen as some company that needs to be take a look at from the big boy club, right? The Wall Street people have to come to the consensus that this company is worth investing. Um, so for to answer your question, it's rare to find this opportunity right here. So for me, of course, coming in late, I bought in over here, not knowing anything about the balance sheets, right? Of course, I'm learning as I go now. I've learned more and more, but I got in around 60 right here. Not all in, but I bought in like as I go. Um, little percentage at a time throughout my portfolio over here. And so my cost average right now on that old portfolio that I have when I was buying in heavily up here is around $45 a share right there, right? That's my old portfolio. Of course, I have more, adding more down here heavily as well. So technically, my overall cost average is around 30 to 25. Of course, I don't do, I have two accounts, so it's hard for me to get to the right. So that's why I'm always ballparking. So I'm close to the green as much as can. So, and of course, I'm still adding more as time goes on here. For me, of course, if I were to calculate back then over here, I was buying the company at 20% equity, right? Again, ballpark. I need to go and get the number correctly because back then we don't have the balance sheets that we have. We don't have, the cash position that we have. So the amount of equity that we have back here was a lot less, right? So it depends on the price range in which you get into GME. It's going to determine how much percentage that you get of the company, right? So the way that I come up with that is to look at the book value, right? Just like Marantz was saying. I highly do you watch Marantz rants by any chance? I'm sure if you're here, you probably come from Marantz anyway, and he's always giving me a shout out, so I always appreciate that. But yeah, if you watch him, I'm sure he does a lot of explaining on that one. Um, okay, good. So I'm sure you know what shareholder equity is, but just off chance you don't, let me see. I thought I have. There we go. Eh, balance sheet right here. So like right here. So this is what I go by, right? Of course, this is wrong. Well, wrong because like it's not up to date. We know that they have $4 billion right now, and so um, that is going to account for the shareholder equity, right? So if you have $4 billion divided by um, the current price, right? Book. Oh, hold on. So the current price here, price to book. So 10 billion divided by 4 billion, that's two times its book value. So that's how you come up with the percentage, right? So currently, if you got in at this price point, so let me reiterate that just in case somebody else watching. Um, so 10 billion divided by 4 billion, that's the shareholder equity, right? So currently, if you do that math, you're getting 41% equity of the company. Now, if the price spike, right, you're gonna get less percentage of the company. So if it's at 20, you get 50%. So that's why. Now, if you want to compare industry, right, like the industry base, we are in a retail base, right, specialty retail right here. And so typically, price to book is that 10? Hold on. So this is PE ratio, profits. I don't know if they have that metric here. Price to book indicator. Oh, you have to pay for those. I'm too cheap, you guys, so I don't pay for any info here. So, but if you go to, let's say, Best Buy, let's just compare it to Best Buy. Why Best Buy? It's pretty close to what we're selling, right? Of course, it's not completely, a fair comparison here, but price to book for Best Buy is around 5.9, right? So if GME is trading the same, it means that 5 times its book value. So 5 times 4 billion, that's the equity, would be around 22. Wait, hold on. Am I doing the right math here? Yeah. So around $22. So that's the share price compared to industry. Wait a minute. Am I doing the right math? Sorry, you guys. My bad. So 20, no, the revenue. Oh, wow. I just noticed something. Revenue 24, share, okay. Is Best Buy undervalued? I feel like Best Buy. Okay, five times its book value. Mm-hmm. Seems low to me. Hold on, let me go back here. Oh, you know what? I forgot. Maybe market cap instead of share price when you get 22. Oh, you know what? The reason why I got 22 is because I use $4 per share actually. So I should use $10 per share because that's correct. I'm still uh, in the old, like if you were to look at the book value currently on GME, it should not be at $4 per share. It should be at $10 per share, including the 4 billion. Yes. So five times its book value current at the current state, it should be $50 a share. Yeah, you're right. Right. Thank you, bud. Appreciate that. Um, so just to show you why I got the confusion, is I use this number right here. So that's the old number, right? So when we have a new balance sheet for the next quarter, it should be at $10 per share. Yeah. And why 10? Because we have that for three additional $1 billion that we raised through share offerings. And so, yes, that's why I got confused there. So let's go back to Best Buy here. So if you were to compare to Best Buy, currently as it's trading at five times its book value. So if it's trading the same, the same valuation based on the book value, the GME should be around. Hold on, should be. I remember this number. Should be at $61 right now. So, again, is that fair to compare? I think so. I think so, and this is why I use five. This is where I got the 50% of $50 from is through Best Buy. So five times its book value. It's pretty fair to do. Anything above five times, it's a bit overvalued, but it's still, again, based on sentiment, based on enthusiasm, based on people are misinterpreting, based on the short interest, how many people are shorting the stock and try to get out as fast as possible. Again, these are speculation based on the structure of the market, right? Based on how many people bought call option, based on how many people buy put option, right? So all of that is taken account to make the price movement the way that it is right here, right? Um, and so that's why you see the spike for no apparent reason because people are betting up, and betting it down, and they do that usually when people hear the news or whatever, they become overly enthusiastic, right? They think, MOAS is tomorrow. it's it's amazing how, the human psychology is based on the price action. And again, this is where, the top people are usually they have more time to wait and they're not as um they're not as antsy as we are as retail, right? And again, this is traditionally why people flock into buying what the institution buy, because typically retail usually sell in and out very quickly, and because they don't know the value of something, right? And so if you understand the investment from the standpoint of the balance sheets, you would be a lot more sane, a lot more stable in the way that you invest. And again, like you're not going to become a billionaire overnight. I mean, even Rowan Kitty, with the knowledge that he has, with the options and all that stuff, it takes him 5 years, you guys, like, to get to this point, right? And even then, before the first run right here, he was in it like way over here, right? Like way over here. And he just dollar cost averaging down as much as he can. And when he saw this opportunity, of course that back then it was a risk, like a lot of risk over here versus now close to zero risk, right? In my opinion, right? Because back here we're still burning cash. We were, not, yes, we have more asset than liability back then, but we were burning cash. We're still going through the overwhelming amount of stores that we have. Nobody wants to address that. They still want to expand, and I'm sure they would try to, dilute the shareholder. But thank goodness, this spike comes up. This is when leadership was offering shares at the time, 5 million shares to raise money, and we've never raised money up until now, right here. And so again, those $1.6 billion that we raised back then last us 3 years, 1.6 billion. So what do you think is gonna happen with $4 billion right now? And again, back then we were burning cash too, you guys. We were burning. Now, when I said burning, I mean we were paying off debt back here, right? $300 million worth of debt right away. And we even paid premium, or we were paying more to get out of that debt because leadership. I'm sure we kind of protecting the asset of the company based on that decision. And yes, we were not growing as much as we wanted to, right? Because of the NFT thing. Yes, we make some mistakes along the way, so to speak. It's just that the regulator are not, uh, permitting, any industry that is trying to go into the NFT space to survive or to thrive. Actually, they just put a damper on it, right? So currently, again, I'm sure NFT is still on the book if we are able to use crypto as some sort of a legitimacy here. In my opinion, obviously. So, uh, uh, but again, those NFT that people are touting that were, a terrible mistake may still come back as a platform that people will still use, right? So again, currently we are doing somewhat in an NFT type thing too, but based on the trading card, right? In my opinion, we could still mint all of these on the blockchain if if it's become legitimized, right? And of course, crypto has been coming back. I'm sure in 5 years, because now BlackRock is into Bitcoin and Ethereum. I'm sure these big guys are not going. I mean, Jimmy is not going to be left. Um, you know, it's not going to take advantage of that, right? Leadership's going to still put those NFT up on sale, but now we have a brand to go along with it. um, yeah, there's gonna be a lot of naysayers out there who bet on the demise of this company still, and they're gonna try to put obstacle in terms of psychology, obviously. But if you were to look at the balance sheets, anyone who focus on the balance sheet is going to win at the end, in my opinion, still, right? But yeah, sorry, I'm kind of long winded here today. Oh, thank you. Appreciate that. Yes. I hope I explained that clearly. Now, I was watching this particular video. I've been watching him pretty on and off, but he really put the context of like retail apocalypse. right, into perspective. And of course, like I was kind of like um, feeling that even in my personal life, right? Going to the mall myself, I used to, kind of experience the same um, kind of sentiment here. And if you look at his video here, I don't want to play too much here because it's his content, but he's just showing around that the mall hasn't been like foot traffic is not there. And of course, like with GME, we are mall based too. Is that like most of our stores is in the mall, and so this is indicative of what is happening right now. And even 3 years ago, when we used to have so much more stores than we have now, close to 2,000 store more. I mean, imagine if we still have that 2,000 stores right now at this moment and not making money at all, right? We would have been in a worse position that we are right now. So in 3 years, I'm sure, leadership has foreseen this happening. And, for 3 years, we've been bashing down in terms of the price, in terms of like the strategy in which we're using in order to survive in this economy has been bashing from the media saying, all he's doing is cut and cut and cut. Well, the reason why we're cutting is because there's no demand there. So what do you want leadership to do? Is that, why are they not spending money to expand more? Expand why? Why would you want to do that? Why would you want to use the resources that would have keep the company afloat in the environment in which you don't make as much money because of this particular economy that we're dealt with? And I know, the news, because like people are making money on the stock market, sometimes people forget that most people don't have money to spend. Everything is more expensive. Food is more expensive. I mean, if you look at the groceries compared to 2 years ago, it's like double, right? So everybody's feeling the pinch. And so, as a retail, we are, in the discretionary spending, we're going to take a hit as well. So, and to put it in context, right? Um, with the amount of top line revenue that we have decreasing over the year, that, the headlines is like, oh, this is the end of GameStop. It's a miracle that we're still coming at a positive. Um, and so that's kudos to leadership right there, right? And to say that Ryan Cohen doesn't do anything, doesn't say anything, he's this and that, become very frustrated because he doesn't give you any guidance and all that stuff. That's BS. I don't need guidance to see the trend that we're trending in the right direction. You see what I mean? So all you need to do is just some knowledge of plus and minuses, and to kind of look at the most important thing, right? And I always like think about this, right? I was like, okay, so in my personal life, do you want to make more or do you want to keep more, right? To me, I, I don't care if I get in, if I make $1 million, and by the end of the year, I keep zero, and not even keep zero, losing money, like in the negative. There's no reason for me to earn $1 million in top line revenue and lose $500,000 at the end, or 100,000, or even $10,000 in the end, right? To come in the negative. But what if I could cut that, revenue up by half, right? Because we used to bring in what, $9 billion, remember, right, a year. If I cut it in half and come in positive, that's actually a better company to for me to be in my opinion, right? Or in my personal life too, because at least you get, you after all of the expenses, you come out ahead, even though you earn $500,000 instead of $1 million. Yes, $1 million, like it's a kind of like a surface level thing. If you tell people, "Oh my God, my business bring in $1 million," Okay, how much did you get to keep? No, actually, I lose money. So, but I earn $1 million. Isn't that great? Nah, nah, it's not great in my opinion. I would much rather have a smaller business that it comes positive. Um, and especially in this environment too. It's like you see when he walked through the mall, nobody's around. Nobody has the money to spend anymore. And so all of the consumer are tapped out. Okay? And so that's important there. Okay. So, okay, I've been kind of babbling a lot here. So let me end let me end with this particular point here. I'm sure you've seen Larry Change live before, but this particular point is having to do with the capital raise, right, and the environment in which we're living in. Um, as far as like low interest rates and the ability for the company to use the capital or raise the capital when it matters most. Okay, so let's listen in.
Um, yes, I remember this. So I wrote this, about 4 months ago. So two buckets: one, inefficient spend today; two, transformative opportunities tomorrow. Take capital out of the first and move it into the second. Cutting spending today isn't about not investing in growth. It's about building a capital base to invest in better opportunities tomorrow. So the context of this post was really an observation that I've seen over many, many companies, many of them. What's happened is a lot of companies have been built in an environment where capital was free. Call it the 2015 to 2020, 21 timeframe. Interest rates were zero. Capital was free in our world, largely free, and companies were raising tons of capital. And what was happening as a byproduct of that capital raise is people were spending it quite aggressively, and they weren't doing it in a disciplined fashion. And then what happened? Interest rates rose, stock market corrected. Capital is much more expensive in our world today. And what that has forced is discipline. And so now you only spend capital on things that you have a definable ROI, you think can be accretive to your business. And that discipline has been very, very healthy. And what's happening with some companies is that the lack of capital has created a discipline which has found the seam in these businesses where you should actually spend capital. This is the accretive seam. This is where this can have a high ROI. But what you don't have now is you don't have capital. So you've come from an environment where you're like throwing capital away at things that don't generate great returns. The absence of capital has forced a discipline which shows you your seam, but you don't have access to capital. So what do? You try and get profitable and you cut expenditures. And the cutting of expenses in the context of a company can sometimes seem like you are giving up on growth. But that's not really the mentality to think of it with. Cutting expenses is really the installment of banking capital to pursue more transformative opportunities in the future. If you can't get capital externally, you have to get it internally. And you do that by running a more efficient business. So sometimes when you start rationalizing expenses inside of a company, what the culture and the way people receive that is you're waving the white flag on growth. And that shouldn't really be the way you think about it. The way you should think about it, it is the first step towards creating capital to grow in the future. That process may take time, but it's a necessary step. And so I do think a separate thought on all of this is the best way to behave when you do have capital. The best way to behave is like you don't have capital. That is the best way to behave. So great CEOs will sort of institute a culture of a lack of capital, even if you have it. This applies corporately. This also applies at the household and personal level. The smartest people, when they accumulate capital, will still act like they are preserving it and still executing on expenses and investments with a great discipline. So that's where this post came from, and I hope that is helpful. All right, so those are.
So yeah, I mean, of course, like I can't even explain it more than that. Like I hope it's self-explanatory. To have the capital and act as if you don't have the capital is the best way to go, right? In the environment when people are spending like crazy, Lamborghini, two houses, and all of that stuff, right? Overextending themselves in order to create that illusion that you have more than you actually have. That is not a good way to go because now when you need the money to, go into an opportunity, you don't have the money to go into that opportunity. And so that's what he's explaining. And I think this is where, Ryan Cohen, and when he said great CEO, I'm sure he referred to Ryan Cohen there. And, just so you know, if you don't know this already, Larry Chain is a chairman sitting on the board of GME. And of course, right there, it's in his bio there. But yeah, so, ooh, I think I'm turning. Am I still streaming? I guess this is a sign for me to get off. But here we go. So this is it. I know you guys. I'm so sorry if I'm long-winded. I don't know if you're still, uh, you know, uh, here. If you make it to the end, God bless you. But yeah. So we still have good website to go into to shop here. E-commerce is here well and alive. So if you want to add more to your collection here, trading card, of course, I'm not a collector here, but oh, thank you both. Appreciate that. Um, so I might start the collection when I have the money too. Currently, I'm just a little, uh, you know, um, fiscally conservative myself, so I want to add more shares to my collection instead of. But I do, want to shop whenever possible. Now, usually I want to upgrade my system here. Eventually, I'm gonna want to get some. Hold on, let me see. Where right here? Maybe, maybe some of the desktop here. I do want a new computer though, so I'm gonna be kind of shop at Gamestop when I have the money too. Obviously, currently my system is still working, so I'm okay. I think my computer is like around 3 years old, so it's not too bad, not too out of date or anything. So, but maybe next year I'll think about upgrading. Of course, I haven't been playing games too much. I used to play games a lot too, but currently I just don't have time to do that. I feel like, oh man, I want to talk about GameStop more than actually playing games. But yeah, thank you so much for joining. And again, like I'll try to do better, in terms of organization. But usually this is how my brain work, right? Just jumping all over the place. And if I become too organized, I'm like, this is so boring. So that's why. But I hope you enjoyed the show. And thank you so much, both, for saying that. All right, I'll let you go. Thank you.